Module 2-2 Fundamental Analysis for Income Stocks. Here are some key financial ratios and metrics specific to income stocks that can provide valuable insights for investors. Dividend yield. Dividend yield is a commonly used ratio to assess the income generated by an income stock relative to its stock price. It is calculated by dividing the annual dividend per share by the stock price and expressing it as a percentage. A higher dividend yield indicates a higher income return on the investment. However, it's important to consider dividend sustainability in other factors alongside dividend yield. Dividend payout ratio. The dividend payout ratio measures the proportion of earnings paid out as dividends. It is calculated by dividing the annual dividends per share by earnings per share, EPS. A lower payout ratio suggests that the company retains a larger portion of its earnings for potential future dividend payments or reinvestment. A higher payout ratio may indicate a greater risk of dividend cuts if earnings decline. Earnings per share, EPS. EPS is a fundamental metric that indicates the profitability of a company on a per-share basis. It is calculated by dividing the company's net income by the number of outstanding shares. For income stocks, investors often assess the growth and stability of EPS over time to evaluate the company's ability to generate earnings and sustain dividend payments. Dividend coverage ratio. The dividend coverage ratio compares a company's earnings to its dividend payments and helps assess the company's ability to cover its dividend obligations. It is calculated by dividing earnings per share by the dividend per share. A higher coverage ratio indicates a greater ability to sustain and potentially increase dividends. Return on equity, ROE. ROE measures a company's profitability relative to its shareholders' equity. It is calculated by dividing net income by shareholders' equity. A higher ROE suggests that the company is generating greater profits for its shareholders. A consistent and healthy ROE can indicate a company's ability to sustain and potentially increase dividends. Free cash flow, FCF, to dividend ratio. The FCF to dividend ratio assesses the company's ability to generate sufficient free cash flow to cover its dividend payments. It is calculated by dividing free cash flow, operating cash flow minus capital expenditures, by the dividend payments. A ratio greater than 1 indicates that the company's free cash flow is sufficient to cover its dividend obligations. These financial ratios and metrics can provide insights into the financial health, dividend sustainability, and profitability of income stocks. It's important to consider these ratios in conjunction with other factors, such as industry dynamics, company-specific risks, and overall market conditions. Additionally, comparing these ratios with industry peers and historical trends can help investors make more informed investment decisions.